The Dollar War. Podcast Script, Episode 4 of 4. Part 2. The Framework, How to Think About Your Portfolio in a Multipolar World. Before the specific recommendations, the mental model that makes them make sense. The 3 risks you are actually managing. Most retail investment advice frames the problem as risk versus return. How much volatility are you willing to tolerate in exchange for higher expected gains? This framework is useful in normal times. In 2026, it misses the most important risks you face. Risk 1, Purchasing Power Erosion. This is the slow theft. Inflation, even at relatively moderate levels of 3 to 4% annually, compounds into devastating purchasing power loss over a decade. Your savings account earning 4.8% looks great until you account for the fact that the inflation index the Fed uses to measure price stability consistently underestimates what middle-income households actually spend money on: housing, healthcare, education, and food, all of which have inflated faster than the headline CPI figure. Risk 2, Dollar-denominated concentration. If your savings account, your 401k, your emergency fund, and your income are all denominated in US dollars, you are entirely exposed to any scenario in which dollar purchasing power declines relative to real assets. The Mitchells in our example have diversified their financial risk, stocks plus bonds plus cash, but have not diversified their currency and asset type risk. These are different things. Risk 3, Sequence of returns risk with geopolitical overlay. This is the retirement planning risk that gets insufficient attention. The order in which market returns occur matters enormously for people who are accumulating or drawing down assets. A major geopolitical event, a Strait of Hormuz disruption, a Taiwan crisis, a sovereign debt event in a major economy, that hits in the years just before or after your planned retirement can permanently impair your financial security in ways that a market decline in your 30s simply cannot. The portfolio architecture we'll discuss is designed to address all 3 risks simultaneously, not just the first one. The allocation philosophy, real assets first. The core insight behind what follows is simple and historically well supported. In periods of monetary instability, real assets, things with intrinsic utility or scarcity that cannot be printed, outperform financial assets, paper claims on future cash flows denominated in a currency that can be debased. The 1970s are the most studied example. From 1972 to 1980, the S&P 500 returned approximately 6.7% nominal, which sounds acceptable until you account for the fact that inflation averaged over 8% during this period, meaning real returns were substantially negative. Gold, during the same period, increased from approximately $46 to $850 per ounce, an 1,800% nominal gain. Real estate, energy, commodities, all substantially positive in real terms. The current environment is not identical to the 1970s. But the structural parallels, persistent inflation above central bank targets, elevated commodity prices driven partly by geopolitical supply disruptions, central bank credibility under political pressure, are striking enough that the broad lesson applies. Real assets first. Financial assets second. Cash last.